What are like the returns of investment?
It could be like 200%.
The most important skill someone actually needs to have when he wants to be a high frequency trader.
It's all about speed.
I start to understand.
Key aspects here is also to be the first on the market.
You would need to teach me right now.
A lot of people can achieve this level. It's not that difficult.
Do you sleep well, knowing that your machines run 24/7?
You can't really sleep if you trade all the time.
And what's the worst thing that ever happened?
A lot of things happened over the years.
If it goes 1% down the price, you're basically bankrupt.
It's way easier to start something in the new space where everybody is a newbie.
All of the markets are kind of the real collection of all human emotions.
If you know how to execute things fast, you don't even need to be that smart.
The following is a conversation with Maxim Korystov, founder of Europe's leading high-frequency trading company based here in Switzerland. We'll cover everything: how high-frequency trading works, where the edge really lies, and how these lightning fast trades actually happen. I really love this conversation and hope you do too. Enjoy. What is high-frequency trading really like? Can you walk us through really the step-by-step guide on what it is, how it works, and assume I'm a complete noob at the subject, which I am, and walk us through?
Sure. High-frequency trading is the way to trade. But a lot of people just trade with their manually. They see the chart, they press the buttons, buy and sell. It's the same thing, but instead of a person hitting the buttons, it's the algorithm that actually hits the buttons, and it makes decision really fast. When I say fast, it's depending on the market, but it could be nanoseconds, could be microseconds. A blink of the eye, really. This algorithm, it analyzes the market, looks at the charts, all other data, and decides whenever to buy or sell.
So the most important edge here is really the speed. So you gotta be the fastest one for this particular strategy.
There's a movie, it's called Margin Call, where there's a scene in the movie where like a board of directors gather during the night in a skyscraper in the main meeting room. And the guy, the head of the hedge fund, he says, there's 3 ways to make money in finance: is to be the fastest one, is to be the smartest one, or to cheat. And he says, I don't cheat. So he assumes that the hedge fund works with the smart people. That's why they make money. So I agree with this statement. And I think in our case, it's all about speed. If you have speed, you don't even need to be that smart. Let's say if there are several strategies that they can do in high frequency trading. For example, arbitrage. You have 2 assets that rely on each other. For example, let's even consider, I don't know, Bitcoin, right? Bitcoin and Ethereum. When the Bitcoin goes up, most of the time Ethereum also reacts to this movement. And if you can notice that Bitcoin price is moving, you can take action and buy ETH as well at the same time. But in order to do it faster than everybody else, you need to be fast. You need to be
Does it only work with different pairs, for example, Bitcoin and Ethereum, or does it also work like with Bitcoin and Bitcoin? Because I could imagine probably if, I don't know, a huge amount is being bought on one exchange, price might go up. On the other exchange, it's still a bit lower, right? And basically, you're the guy who captures that value in the middle, right? And makes it even again.
Yeah, that's the interesting part about crypto. There are multiple markets. Like, let's say, like in the US, for example, there are just few big exchanges like NASDAQ, CME, Chicago Market Exchange. But in crypto, literally there are like hundreds of exchanges. I mean, there are few big ones, but still. And they all located in different locations. So let's say like some of them located in Europe, some of them located in Asia. And whenever something happens, like, I don't know, Trump tweets about something about crypto, the price starts to move. It started to move in one place, and then it spreads out across the globe with the speed of light, actually, because there are all these cables, all those different ways of communication between those data centers where the exchanges are located. And those people who do high frequency trading and execute arbitrage strategies, they're trying to catch those waves and see that the price moved in one place, in one exchange, let's say BTC, and they're trying to reflect it in another exchange.
And is this the only strategy you can make, the arbitrage, or are there multiple that are being used?
There are actually a lot of them. Like arbitrage is the most basic one, right? Like it's just easy. One place the price moved, you just reflect it in another one. There is another strategy quite popular. It's called market making. It's where you provide the liquidity. The way how the market works, in most of the places, there's like an order book, basically a list of people who wants to sell and buy. The same like on the market, you go on the market, you can buy the tomatoes. There are different sellers of the tomatoes. There are different people who want to buy the tomatoes. It's just like formalized way of representing this. It's order book. And people just so we're talking about market making now. So just you provide liquidity. You say, I want to buy. You just put like orders in this order book. And whenever a trade happens, it's when two traders find each other. One wants to buy, another wants to sell. And one that initiates the trade, it's called like aggressive trader. And the one that takes provides the liquidity, they called are like a passive trader. And usually the one that aggressive, they pay the fee, and the exchange takes some of this fee and share it with the passive trader. So so you can stay in the order book and basically collect the fees from the trades. Let's say if you just buy and sell at the same price, you don't make any money, but you collect the fees, and that's how you make profits.
And this also goes in the higher frequency trading category.
Yeah, because you also have to react fast. Let's say if the price moves, you have to you want to withdraw all your orders. You don't want to buy or sell for not fair price.
So, but how can I imagine this? Like you put a buy and sell order at the same time and you kind of get the fee, or like what's an example you could give us to kind of abstract this a bit better for the audience?
We can just imagine the market, the market on the square in the like old town, let's say, and you notice that there are different prices in different like different sellers, they use different prices. So essentially you just buy with the lower price and sell with the higher price. And even though the difference is quite small, but you do like thousands, like 10,000s, 100,000 times, and that's collects the profit.
And is this like on the same exchange? Is this on different exchanges?
Could be even different exchanges.
Yeah,
you could have like different positions in different exchanges and just hedge them against each other.
Yeah. Okay, I think I start to understand. And where's the edge today in high frequency trading? Is it still purely about speed, or is it also a lot about infrastructure? I could assume, because speed means being close to something, right? Or is it about something else? What is like the main edge these days about high frequency trading?
It really depends on the market. These days there are so many markets, especially in crypto. It develops so rapidly. There are different, like as I said, there are like hundreds of exchanges. Some of them centralized, some of them decentralized. So you can even like arbitrage between, let's say, a centralized exchange and something that happens on chain and make profit using this way. So I think the edge is to be up to date with the recent, technologies, and just be aware of what's going on in the game.
So basically, really understanding the markets, how they work, is kind of really the prerequisite, and then just executing this knowledge kind of fast, in a way,
and
right?
Not even I think one of the key aspects here is also to be the first on the market. If you one of the first few traders on the market, there is no much competition, and you can just dominate the market essentially. If there's something, some new exchange opens up or some new technology appears, if you one of the first who start using this and doing this, high frequency trading in this area, then you're going to be successful.
And how does this look from a technical point of view? Like what kind of systems do you need there? How does it really look in a kind of abstract kind of way, what you have and what is actually trading? Is it still you kind of in the loop tracking everything, or is it really fully autonomous, something in the middle?
Yeah, there's still people. I mean, depending on how do you build a pipeline in your, in your trading systems. But in our case, we still have people who like look after the strategies. Usually, the loop looks like this. First, you analyze the data. You have market data for like, let's say, I don't know, months, years, whatever, for some period of time. You have some ideas. Like, let's say I think if on exchange A the price moves, then on the exchange B the price will also move, and you like kind of formalize this idea in a formula or like in a code, and you apply this code to all the market data. It's called like backtesting. So you have the data and they just test on this data. You're confident enough that actually in like most of the cases this rules applies and you can actually make profits. So then you're trying to put this strategy into production. There could be different challenges. Maybe some of your maybe your test environment wasn't that, maybe you're too optimistic about your latencies or some other aspect of the backtesting, and you just didn't account for all the things. So that's, you'll see the difference in production. But yeah, usually you roll it out to production, see what's the difference, get new ideas and try to go through this loop again.
And like, if you go even deeper, really on the tech stack level, what is this? Is this like a Python script that is just kind of run every tick that you have on the market, or what exactly is actually running this code?
Depending on the market, but most of the firms that I know, they use something more like robust and more something fast, like C++ or Rust, something that can process a lot of data in a short period of time. So mostly like C++, essentially, like a lot of C++ code, a lot of work with the network, because the connectivity network is one of the, I think, key aspects here, like to be to receive the signal as soon as possible, to send your order or cancellation of your order as soon as possible.
So in a way, there's always like a trigger, and then a specific workflow is being triggered inside of your system with C++ code or whatever, and then you perform an action or not, given that signal, basically. Yeah. And how does that signal exactly look? Like
whatever you define it. Like, let's say the price moves let's say like 0.1%. The price moves 0.1%, then you do an action. If it moves up, you buy something. If it moves down, you sell something. So that's the idea that you can start with, and then you apply this idea to the market data and test. What if I was running this strategy for like 1 year? Would I be profitable in the end or not? And maybe sometimes you see some moment and say, oh, this is a great idea, it would work for this week. For this week it's so successful. But then you run it on the longer period of time, for a year, and you can see that there's different seasons. Sometimes the strategy just simply doesn't work.
And your company mostly focuses on the crypto part, or also on other markets?
We focus mostly on crypto, but we also have some involvement in the classic markets. But there is the game is different in terms of, so a lot of things in crypto happening. Let's say there's like multiple exchanges, and the game is about connecting those exchanges together in a way. With classic markets, it's also a case sometimes, but it's mostly about staying in the data center, and it's mostly about working with hardware, because in the it's a little bit different scale when we're talking about classic exchanges. It's all about hardware. How do you deliver signal from one part of the data center to another? And that's where all this expensive hardware gear comes in. We have to like understand how each part of this infrastructure works really well and optimize for this. So it's not even about an idea here. It's mostly about like understanding the hardware, what you can do with this.
But this is mostly for the legacy market. So for the crypto market, it's more about connecting the dots. I don't know, finding like one unified thing that you can.
Crypto is way more slower in this way, because they just spread it across the globe, just in different places. Where in the classic markets, legacy markets, it's mostly in one place.
So if you do high frequency trading on the legacy market, it basically means you must be the guy with the biggest and most beautiful server closest to wherever you want to trade,
Yeah.
in a way.
Yeah.
And this is like the only thing, or the thing that matters, basically,
Yeah. In the legacy market.
in the legacy market.
Yeah.
And for crypto, the software layer is a bit more important, I guess. It's kind of like the hardware layer for the legacy market.
You have to be a little bit more, let's say, smart in crypto.
Okay.
I would say.
How so?
Because it's more about the strategy, less about hardware. It's difficult to compete with the hardware. It also should be on some good level, but it's a lot of people can achieve this level. It's not that difficult. So the most money are in the being smart here, like, but still in the fast way.
And what does being smart mean? Like, do you have, I don't know, your own AI models deployed that do decisions? Is it like more of a mathematical rule approach? If this, then that, or both?
So mostly, it's mostly about like statistics.
Okay.
So it could be anything. Could be, as I said, for example, this could be a strategy. If the price moves 0.1%, you do something. But of course, markets are more difficult most of the times. So one person can't really account for all those features. So that's where you usually come to machine learning. But it's still mostly people use some simple machine learning models like decision trees, gradient boosting. Some people use neural networks, but still they're quite it takes some time to inference them, to just get the result from the neural network, and you have to do it like every millisecond, maybe even faster. So that's why people try to optimize and use some more lean models like decision trees.
So I guess we'll never see like LLMs doing high frequency trading, just because, at least for now, they're way too slow, I guess.
Yes, but there's other areas. Let's say it's not only high frequency trading, but also like mid frequency trading, or it's all about how long you hold the position. Like, let's say you make a decision to buy, you buy something, and then you hold the position for days. There are some models that analyze the market on this scale, for example. But for the smart models, you have to have like some good signals. Some good data to feed into this model. There's a cool example what people used to do like 20 years ago to predict the price of the Walmart stock. They would collect the satellite images of the parking lots in front of the stores and count the number of cars that's there marked next to the stores, and based on this they would predict the result, the financial results of the company, and trade. The public companies, they have to publish the reports every quarter, and they would trade the stocks around this period of time because they have the data. They have like some kind of data that would predict their sales. That's what people used to do like 20 years ago. But still, that's a good example of kind of signal that you need to have like an edge in terms of the data to be smart. So it's not just about hardware.
But this then falls more into the kind of mid-frequency trading, I guess, right?
Yeah.
So it's not really relevant for your specific use case. There's much more about the infrastructure, but really deploying smart models and actually understanding and just speed.
Yeah, but it's like a spectrum. You can go from being slow and smart to be like less smart and faster. So you have to pay for being smart, essentially. If you want to use neural networks, it takes time to, and you have to also have like a lot of data. Like, for example, if you talk about high frequency trading, it might be like a couple of months that you need to train your model, because there's so many like you split up the whole timeline in small like parts, and there's so many parts. If each part is like in a couple of milliseconds, there are like millions of them, even more in a month period. But if you talk about mid frequency trading, you have to take into account like a longer waves and longer signals, so you need data for like years, 5 years or more.
And how long do these back tests that you mentioned take usually?
And it also depends. We have in our company, we have like ad hoc solution, state of the art actually. It also depends on the market. Could be minutes, could be hours, depending on how many parameters the researchers try to optimize for. Could be.
Because I guess in your case, if you really optimize for the milli or nanosecond or whatever, what is the unit that you measure? Is it a millisecond or
in crypto is mostly, I would say, micro milliseconds.
Micro.
Let's say milliseconds.
And on
like
legacy markets?
Nanoseconds.
Nanoseconds.
1 billionth of
can you like put this in order? So there's seconds, then there's milliseconds.
Milliseconds. 1 millisecond is like 1/1000th of a second. Then microseconds like 1 million.
Okay.
And 1 nanosecond is like 1 billion.
Oh wow.
1 billion nanoseconds in a second. Can you imagine, like, just open your mouth and it's already
I cannot, honestly.
several millions or
I think
nanoseconds.
our brains are not made for this.
Yeah.
But so okay, on the legacy market, nanoseconds, so a billionth of a second, and in crypto, milliseconds. Okay. Because imagine if you have a billionth of a second, if you need to backtest that.
Yeah.
I guess you have like
That's
one
where
tick per billionth of a second, right?
Actually, it's not even the software engineering; it's physics already.
Yeah.
Yeah, because this hardware is optimized in the way that it just, sees the signal on the one side of the cable, it just fires the another signal on the other side of the cable. It just all the, there's those special. Some people build like special CPUs, especially for the strategies, for the trading strategies. So they go to the TSMC, this Taiwan-based CPU maker, and they say, we have the trading strategy. We just need to make it like a CPU that would just, it can only do one thing, execute the strategy, nothing else. But it does it in such an optimal way that it just optimized for this. And they use this special CPUs for trading.
Wow.
But it's cost like, I don't know, tens of millions to, to design and actually make them.
And can you buy this from them, or?
No, I mean,
what kind of tech do you use?
It's usually very, they do it for them. It actually doesn't make sense to buy them unless you have the whole team that, designs the CPU and does everything else. It's very like custom, I would say. So but it also depends on the market. Like if the market gives you so much money that it makes sense to spend and invest so much, resources into hardware, people do this.
But so in your case, you basically buy the hardware off the shelf, you optimize it with the right location, the right software, and that as far as
is
all right.
Much easier.
Yeah.
So far. But now, a lot of crypto in the last couple of years came to the legacy markets. There's those ETFs that being approved. Like every month we hear there's another BTC. Now there's even ETH ETFs that being approved, and they're talking about Solana ETFs. So a lot of, it's kind of those two markets, they merge slowly into each other. And in those legacy markets, since you have those crypto assets now, you can use the approach from the legacy markets to trade crypto now. So I guess those people who are on legacy markets, they can take advantage of this.
And they're gonna win, right? Because if one guy makes decisions on milliseconds and the other on nanoseconds, well,
yeah, that's true. But still, a lot of the main signal, most of the things in crypto happening on those crypto exchanges rather than American exchanges. It's something happening, let's say on Binance or OKX on Bybit, and then only after like some milliseconds when the signal reaches the US, something happens there. So they're actually catching up to crypto. So it's, if they were staying in the same data center, they could use all this hardware, but since they have to get the signal from somewhere else, from the other part of the world, they still have to rely on they can't really use the software, the hardware that they have.
But why not? Because the crypto exchange also has a physical server somewhere, right?
Yeah.
So what prevents you from just building exactly next house where the server is for the crypto? Why doesn't the same logic apply there too?
Historically, most of the crypto exchanges, they based in cloud, cloud providers like AWS, GCP, Google Cloud Platform, or Alibaba, because they didn't have like enough resources to have their own data centers. So they have to rent rent the capacity from those cloud providers, and they stay this way. And there's some limitations. If you are even if you are in the same data centers, but you use AWS services, there's some limitations on the connectivity that they can use between different machines with different servers within the data centers. In AWS, you can't really control where exactly you get the server. Let's say if you go to the data center, AWS, and you request a new server, let's say in London, in their London region in data center, they just give you a random machine. It could be it could be like hundreds meters away. It could be like several switches away. It's different like pieces of hardware away from the actual exchange, and that's what makes it difficult. You can't really connect directly to the exchange. Where on the classic legacy markets, they have full control over the data center. They can just plug it in next to the matching engine, next to the exchange itself.
Yeah, interesting. Okay, I see. And how do you manage the risks when things happen so fast?
Yeah, not just so fast. It also happens 24/7.
Yeah,
right?
true.
Comparing to
True.
the classic markets, it just you can't really sleep if you trade all the time.
Do you sleep well, knowing that your
Yeah.
machines run 24/7 and
Yeah,
stuff might go wrong?
Yeah, I mean, over the year, a lot of things happened over the years. But over the years, we developed some like stop loss systems that we just monitor. It's just completely different technical stack. It's not related to the strategy. It's just completely different code on a different server, even, that monitors the state and the the P&L, like how much money the strategy makes. And if it just does something wrong and the P&L goes down, at some point it just stops the strategy, closes the position, and waits for a person to look into this. So this what makes us sleep well.
Okay.
So we always know that there's a limit to how much we can lose.
And how do you set that limit? Like, what's the most amount you could lose? You could lose.
Depending on the backtest. So you run this backtest. You see, let's say you run like 90 days, and you see sometimes there are some days that the result goes like $10,000 US. Sometimes they're like minus $10,000. And you say that most of the like normal days, it doesn't go below like 1,000, let's say. And you just set this 1,000 as a reasonable threshold. Because if it goes below, then it means that it's something out of your model that you built for this strategy.
And what's the worst thing that ever happened? Like, inside of the company, what's the most amount of money that actually accidentally got lost?
You see, there's other risks as well. It's not just about how good you are with math and how good your strategies are. Also about the platforms, really. Crypto is a very volatile market, and even people who are like build the exchanges, they also sometimes they manage the risk in the wrong way. And FTX is a good example. That at some point they just stopped withdrawals, and you couldn't withdraw the money. Luckily, my business partner, he was like reading Twitter a lot during that time. I think it was still Twitter at the time. And he noticed that people started complaining that they can't withdraw some of the assets from FTX, but still you could withdraw like stable coins. And that's when he decided to withdraw most of the assets that we had there. So that's what saved us, because like I think in 1 day or 2 days they just completely stopped withdrawals. But luckily we still had like maybe 20% of what we used to store there. We still had with FTX, but it could be much worse. But luckily, like 3 years passed, and now they returning the money. So
you actually got it.
Yeah, I mean, we got like 70% of what we had with them.
Oh, great.
And they saying that they gonna return more.
Great.
Actually, it was an interesting story, because the guys in FTX, they didn't even know how much money they have. They invested in so many different things. So they're like a professional team of lawyers came in to do the bankruptcy of the company, and it took them 2 years to figure out what the company is actually, because they have so much. People had so much authorities there. They just invested in random things. Apparently, they invested in Anthropic, this AI company. They just
That was a good one.
Yeah, it was a good one. There were like several other good ones. but it was just random.
Yeah.
But luckily, eventually, when they put all the pieces together, they figured they have enough money to
Great.
return that to the customers.
Yeah, the good old saying, not your keys, not your coin.
Yeah.
Right. So
Yeah.
I
But
think
now,
there's truth in that.
actually, it was also a positive thing that happened, because it gave a different perspective to the people that you can't trust the exchange, and that's where a lot of decentralized exchanges kicked in, and some of them got really popular because of this. People didn't use them before because they said, "Why would I use them? It just takes more time." If it's happening on the blockchain at that time, the technology wasn't so great, so you didn't have so many transactions per second. You couldn't compete with the same speed. Even clicking the buttons was difficult for people. I mean, you couldn't use all this capacity. But then after this happened, they actually realized, self custody is really might be useful.
Is this what you now do too, for the most part?
Yeah, I mean, actually now it's much better as well, because all the exchanges, they also publish like proof of assets. They show how much money they have. So it's not like a requirement. There's no regulations, I guess, in most of the places, but just
It's more like trust.
yeah, it's more like trust. After it just
Yeah.
became a standard after what happened.
I see. And where do you think is like the future heading in the high frequency trading space? Is it just going to stay the way it is? Is it going to get faster? Is it going to get smarter? Like, what are you now working on to really keep the edge,
In crypto, there are like a lot of different interesting things happening, especially with decentralized exchanges. People try to reinvent how the markets work, even how to match like the seller and the buyer. One thing that crypto already invented, it was like a while ago, almost 10 years ago, they invented this perpetual futures. It's like a future contract that never ends. Usually like a future has like a maturity date when the future expires, but in crypto they found a way to create a perpetual futures because it's more fun for people.
Can you explain this like in simple terms, like a market analogy that you did before?
So let's talk about some asset, like let's say tomatoes, right? You just go and buy or sell them for cash. There's no leverage, nothing. You just had like 100 Swiss francs. You buy like 5 tomatoes.
Expensive.
Enrico, but yeah, but live in Switzerland. So futures is a little bit more different. You don't buy tomatoes. You buy like kind of contracts. It's some like pieces of paper that tells you that at some point, which is called maturity date or like expiry date, you get those tomatoes. But you can sell and buy those papers at any price you want. But what keeps this price close to the price of the actual tomatoes is that it's assigned to some date. At some point you'll have to get tomatoes to exchange your papers. Perpetual futures is the same, but there's no date. And then people asking, how do you attach the price to the price of the asset if there's no maturity date, if there's no expiry date? And they it's quite technical here. Like they introduced something called funding rate. It's when the price of this futures is too far away from the actual price of the spot price of tomatoes. It's either those who hold long positions who like bought, or short position who like sold something. They have to pay a fee. If the price is too low comparing to tomatoes, those who bought something, they have to pay extra fee to those who short something, and vice versa. That's kind of calibrates the market and pushes the price close to the spot price. And in this way, it never ends. And it's actually, a lot of people find it's way easier to understand than just futures.
And me too, actually.
Yeah. Because it's also another thing that with those, since you don't trade actual tomatoes, you just trade those, papers, pieces of paper. You can use leverage, because the exchange doesn't care. You can just, it's essentially like gambling. You just use like the, like I know most of the exchanges they provide. Also, like it sounded crazy, I would say, 10 years ago, that you can trade something like 100x leverage, but crypto is reality. That's what they introduced with perpetual futures.
But that's very dangerous, right?
It's very dangerous.
If it goes 1% down the price, you're basically
Yeah.
bankrupt.
It's very dangerous unless you're a high frequency trader.
Okay, so you actually use
We
100x
tried,
leverage.
I mean, maybe not 100x, but like 20x and
Yeah.
around that. If you know the future statistically, if you see that the strategy that you have, most of the time it does the right thing, you can afford to use this leverage because you want to use your capital very efficient. You don't want to put more money at the exchange. It's just, introduce all kind of risks.
And if this is public, I'm not sure, but what are like the returns of investment of these high frequency trading funds? Like, are we talking, I don't know, 7 to 10% a year? Probably much more. I can imagine 20, 30. Like, is there an average?
It's really difficult to tell. Depends on the trading company. Since most of the high frequency, depending on the company, but most of the high frequency trading funds, they are not like public. They don't have clients, so they don't publish this number because they do this to advertise to other people, saying like, oh, we do like 20% a year, invest in our fund. So most of the high frequency traders are like private ones, so they don't take any money, so they don't publish those numbers. But I would say, yeah, it's really difficult to tell in crypto, since you can use this, high leverage, and a lot of exchanges, they're also willing to give you some credit lines. They would increase your leverage even more. So on top of those 100x, they can also tell, we'll give you like $1 million. If you put like, $100,000, we give you $1 million, and you can use your capital even more efficiently. So it gives you like even crazier leverage. They would do anything to boost their trading volumes.
Yeah, of course.
Something
more fees for them, right?
Yeah, more fees for them, and a way to advertise. Yeah. If you can go there and buy and sell. I would say it could be like a 10%, could be like 200%
a year.
Yeah.
And what's the craziest amount of percent one strategy has ever made you inside of the company?
But again, if you take one, like let's say $10 and make 2,000 out of it, it's a crazy amount of percent, but it doesn't sound that impressive. So I think maybe percents are not the best. It's all about the scale, right? You eventually don't want to make a relative amount of money. You just want to make some absolute number eventually. But I think there was a period of time where also like a couple of years ago, maybe you remember, there was this blockchain called Luna, and they had their own stable coin, and at some point it depegged, and we had a strategy that there was like arbitraging, there was doing arbitrage among stable coins in blockchain, and that was actually very good times because there were several exchanges. People already knew that one. What was the name of this Luna USDT? I think it was UST or something. It was called UST. A lot of exchanges still assume that one UST is one USD, so you can just go there and take those USTs that basically already everybody knew that they cost nothing, and you can just go there and buy a real USDTs or like USDCs or like real USDs with this token, and that was very profitable times.
I can imagine, actually. It's like earning money, right? Basically.
I've seen like a lot of people also on Twitter, a lot of people like posted things to how they would make like millions in one transaction because they noticed that there's this imbalance and just use the advantage.
And let's say you have a young guy who wants to do the same. What would be like the first concrete step for someone trying to be a high frequency trader? Are there prerequisites like you need to code, you need to understand physics, you need to do this, you need to do that? What is like the ideal profile and how to get started?
Actually, I heard a lot of stories how people get to high frequency trading these days. Even people who don't have a team, they just on their own, because there's so many different opportunities these days. There's so many different chains. There's so many different exchanges. Big funds and big companies, they don't have enough resources to cover this all. So it just essentially happens. Nobody noticed this, But if you're like a small player and you're interested even like in the small gains, you can just go there and pick up all these opportunities. For example, there was like a huge wave of meme coins on Solana. People did a lot of money. Just I know a couple of guys who just did them by their own. They didn't have a team. They didn't have anything. They just were software engineers. They liked this idea of blockchain. They knew how to use Solana, how to code on Solana, how to do smart contracts, how to execute transactions and stuff. And they made a lot of profit just executing their knowledge.
But let's say you would need to teach me right now how to high frequency. I mean, I can code. I can probably figure stuff out, right?
Yeah.
Like, where do we start? Like today, right now?
If you do high frequency trading on the centralized exchanges,
let's assume crypto, high frequency trading on
centralized exchanges.
Okay.
Then I would try to find some market data, something to run your ideas on.
Where do I find this? Is there like resources?
There are a lot of resources where you can buy the data, and it's not that expensive actually.
For example,
we don't do this since we collect our own data, but I'm quite sure if you just Google or search for market data for exchange X, you'd find the place.
And do I look it up for a specific pair like BTC to USDT, or
I would focus on something smaller?
Okay,
because that's where all the big assets like BTC, ETH, they're already being watched by big players. So you probably don't want to compete with them.
So I go on CoinMarketCap, page 2 or 3. So meaning like coins between place 100 and 300, like really small market caps. And I try to really go deep on one of these and understand how this specific market works.
Where
basically.
you would need to figure out where the signal coming from. Maybe it's coming from another exchange where this pair is very popular, or maybe it's coming from, I don't know, people post something on Twitter. Or some people even trade whenever something, there are several exchanges when they list a coin, the coin just goes up really fast. And some people just watching the news, they have the build special. It doesn't require a lot of skills actually. You just monitor Twitter or some other channels, Discord.
But can we make it concrete? You say get the market data. Let's say I find coin number 234 on CoinMarketCap. I don't know, what is it, 50 million in market cap, whatever, right? And then I Google coin 234 market data, and what am I going to get? Like,
so you're getting this data essentially just
CSV file or
CSV, or it could be in different format.
Okay,
could be CSV as well. So it's just like a sequence. It's time series.
So
it's for each for some period of time. There's like a current price, how the order book looks like at this particular time, all the trades that happen on the market.
So it's like time snapshot 1, price is 2, snapshot 2, price is 3, and so on, right?
Let's say you do arbitrage. Arbitrage is the easiest one. So you find some other exchange where this pair is traded, and you also download the data for this exchange, and now you have 2 time series, and you have to find the dependency, like what's the what you can do with this, looking at one particular time series, what you can do with the other pair, like say like buy or sell in order to make some profits.
Because it doesn't sound so easy actually, because it probably is going to be millions of data points, and you need to find the needle in a haystack. What exactly?
Well, I mean, there's some machine learning approaches that can help you. First of all, you could reduce the data. You can say you don't look at all the snapshots. You aggregate it, let's say 100 milliseconds or a second. Now you have just, for every second you have a price on left side, for every second you have a price on the right side, and you just talk to ChatGPT or your favorite AI and say, I have this 2 time series. How do I predict the time series B from time series A, given the data in the time series A? And probably it will just, provide you a short program in Python, how to build your machine learning model and train it in order to train it and evaluate it in order to see how your strategy would perform.
So in a way, at the end of the day, it's going to be a rule, and you're going to have an if statement. If this rule is true,
but it could be a rule in a way of being a machine learning model. could be just like a a binary file with, for example, decision trees, just a set of those rules.
Yeah.
Just like hundreds of those rules that they look at some particular features. You could use different features. You can just say, let's take moving average for the last 10 minutes. Let's take moving average for the last minute. Let's take maximum for the last 10 minutes. And you just come up with all those features. You feed it into the machine learning model and you say, this is your features. And you have to predict the time series on the right side, time series B. And you just give those samples to the machine learning and they have to figure out. You just train the model.
Got it. And this, you would say, is the simplest way to get started. Obviously, you can do it arbitrarily complex, I guess, right?
Yeah.
But this is the simplest way. Find small market cap coin, go on 2 exchanges, try to find the market data, try to find certain rules, probably with some LLM, what exactly is the correlation between the two, right? And then try to kind of build that.
Yeah.
And the simplest way, you say, is kind of with this decision tree as the model that decides yes or no.
Yeah. But I mean, this is one way to go. But I also want to mention that it's way easier to start something in the new space where everybody's a newbie. Because in this space, there are like a lot of companies like us, other companies, they already like perfected this. Maybe they're not interested in this market cap like rank 300 category, but still they already have the technology. If at some point they'll reach this 300 rank, they'll dominate this space. So I would try to focus on some maybe new technologies as well. Like for example, Solana is a good example. There's still a lot of things happening with those meme coins, and you can try doing something with that.
Okay, I see. I think if we go deeper, it's probably going to get too technical, I guess, for most people. In all of this context, what would we say is the most important skill someone actually needs to have when he wants to be a high-frequency trader?
I would think it's being passionate about the data. You just, you have to be there. The market data should become your best friend. You have to know everything about this data. Just, looking at this time series, building some charts, being curious about the dependencies between those different time series, just like grinding the data, I would say. It takes some specific mindset.
So it's more about really the data, and the execution layer then is almost the trivial part, it sounds like building the software to execute the trade.
I mean, it also depends like on where you want to be on the spectrum from being like smart to being fast. It's one way to be successful. Another way is to be very familiar with the networking, like computer networking, how servers communicate to each other, how to get how AWS, let's say, works, or Google Cloud Platform works, how you can send the signal from one place to another. You can leverage this skill as well. You can actually, if you know how to execute things fast, you don't even need to be that smart. You just need like a simple strategies, as I described. For example, like if the price moves 0.1%, one direction, you just do something. It's simple strategy. Everybody could understand this.
And is there a list of resources you could recommend for new people, like specific books, specific, I don't know, YouTube videos or something else?
The industry moves really fast. So I would just try to talk to AI, essentially.
Yeah? Okay.
Yeah. I mean, I think I tried it several times for these purposes, just to explore what's going on, and it works really well.
So technically, you could take this podcast, transcribe it with AI, feed it into AI, and then tell AI, okay, now explain me in deeper details how this works. Well, there you have it, guys. That's great.
Now it's these days it's too easy.
Yeah. Okay, that's interesting. I think we've covered quite nicely what high frequency trading is, even in a bit more details. Let's go a bit deeper, I think.
Let's go.
Like, do you think the markets have a deeper kind of order, or is it like mostly random? Because now you mentioned it's all in the data, it's all in time series, right? In the milli or nano or whatever seconds, right? is there like order in the chaos, or is it just chaos?
Well, we get philosophical here.
Almost, right?
Yeah. So the short answer is I don't know. The long answer, if you want to make me talk, actually it's just a representation of the what people think about an asset, how they, what the emotions are. There are good examples in the history. For example, there was this, .com crash 20 years ago. There was this company, Amazon. You probably maybe heard about this these days, and the price of their stock dropped 95%. It's difficult to imagine. It's like meme coins these days. But the company was doing well. It didn't even need that much money. It still had enough money to run itself. They grew in terms of number of users, in terms of numbers of customers, number of shipments, whatever. All the internal features, all the internal metrics were good. But just market decided that the market got emotional and evaluated the company. It just went down 95%. So it's just representation of what people think. Most of the time, it's not even rational. The market is not that optimal in some periods of time. It's an interesting projection, I guess, of what people think, because it's also kind of one thing if you ask a guy like, what do you think this company costs, and they tell you a number, but it's another story if they go and actually sell or buy for this price. So it's more fair in a way. It just represents what people actually think about some asset or a stock or whatever.
In a way, it's like the sum of all human emotions, right? For a specific thing.
But related to particular asset,
Yeah.
like a stock or.
So if this is true, then all of the markets are kind of the real collection of all human emotions.
Essentially, yeah.
Right.
It's a very poetic,
I agree.
romantic
Yeah.
way to say it.
That's interesting. Do you think like there's is there something about speed, that kind of shows you the real human nature in what you do, or do you think that's just a byproduct of what the strategy entails?
What do you mean by speed?
No, like just being the fastest one. Do you think this kind of shows a bit more about the people, or is it just what happens to now be your edge in the specific strategies?
Being fast, like in terms of
in life, I guess. I don't know.
I mean, yeah, there are like a lot of spheres of life where being the first is beneficial. I think entrepreneurship is one of the things, right? You can tell for yourself if you let's say you build an AI company and you're one of the first in this space. I know you do AI for whatever, for some particular software, and you're one of the first who does this. You're probably going to be more successful because you just have more time and you are the most experienced person in the sphere. Yeah, I think just in general, if you are fast, it just gives you more. You can do more actions, get more feedback, learn more quickly.
Mm-hmm.
So, yeah, beneficial.
Yeah, I guess you can do more in the limited time you have, right? Yeah,
true.
What do you think is one thing that I didn't ask now, but a super important question? What would that be about high frequency trading in this specific context, or one question that no one ever asks, but they really should?
That's a good one. It's a good question.
Maybe that's the question.
Yeah, that's the question. I keep asking myself, this. I think it's people want to know what's going to be next, like what's going to be the next interesting thing. I think there's going to be at some point. I mean, it's already started. A lot of we were talking about this merge between U.S. stock markets and crypto.
Mm-hmm.
I think slowly it's gonna happen more and more in a faster way, and at some point those two markets merge, and it's gonna be very interesting time to live in when you don't have where those money and all the financial markets they work differently. They have people have access to them 24/7. They can do these transactions whenever they want. Nobody stops them. There's no like extensive QICs. Banks maybe not going to be that important, especially to retail users. I think that's very interesting thing to dream about. What's going to happen when this merge is complete?
So what do you think is going to happen?
I think market is definitely going to look differently. I think, especially if I worked in a bank, I would, try to be on this wave and introduce as many crypto products as possible, because it's what people want these days.
Mhm.
It's how people want to, exchange money and use financial services. Also, how the governments trade with each other. Also, a very interesting aspect. Now they all use like wire transfers. It could be just like a transaction in the blockchain. I would just think about this. What's going to happen like in 5-10 years if those two worlds merge together?
I think the next big thing we probably need to really take care of is national debt of all of the countries. Like, it's insane, especially now in the US lately, but really every single country, they have so much debt and they add so much new debt, every single day.
But also, it's just a representation, right? It's just like a number that we have, but things are still kind of working. And I also, a lot of people compare this debt to like a personal debt. Let's say if you loaned money from a bank, you borrowed money from a bank, or you're a company, you have like a credit line. But I think on this scale, it works a little bit different. Maybe some countries actually abuse this. They, abuse their trust that people have to them. But still, there's more things you can do. When you do this on this scale, it's more about. It's not even like. It's difficult to compare to like a credit that a person gets. It's more about the trust. It's the number, just a representation of trust that people have for the country.
I guess in a way it's just a hidden tax, because the government can only tax you so much. I don't know, 10%, 20%, in some crazy countries, 50%, right? The real tax. But the thing is, if they print, I don't know, if they double the money supply within a year, well, essentially they taxed you another 50% on top of that. And I think this is what people don't get. And honestly, for me, this is the most important thing about crypto that I really hope they can solve.
You can control the emissions.
I hope so, because I don't know, if you extrapolate this into infinity, I just don't see how this.
There's some different. There are different discussions. Probably Vitalik Buterin, the founder of Ethereum, has a really interesting blog where he's kind of dreaming about how the money could look like. Let's say we could, all this math, all this concepts about money, we just build it ourselves, right? For example, we could do it differently. We could say, if like 100 people, they have $100 each, and they want to put those money together, that maybe we should make the laws of the money so they don't have like 100 multiplied by 100, but like, let's say it's multiplied by some other factor. So like, it's not like the same thing as a sum in math. It's like a different law. You can just say you can just play with those arithmetics of the money, and because it's just a representation of how people work with each other and what they want to achieve. So sometimes the basic math is not the good representation of this. I also think if we just didn't have this way of spend money that we don't have, that we wouldn't move that fast. It kind of helps us to do things that we couldn't achieve if we just didn't have this technology to print money.
Yeah, I agree. But at the same time, the way it's used a lot of the times, right, is mostly for, I don't know, wars or whatever. So in a way, it's a bit of non-productive money, you know, because I don't know if you send, I don't know, whatever, 1 trillion to whichever country is at war right now.
Mm-hmm.
That 1 trillion is, well, it's good for the moment, but basically you're building nonsense, because the nonsense is just going to get
Yeah,
destroyed.
true. I mean, you can of course abuse this power, but you know, sooner or later you'll have to hit the reality at some point. If you abuse it too much, then it's not going to end well.
Yeah, and I think this is the cycle that we're in right now. And especially the US, either they now really can figure out a way of how they don't bankrupt themselves, because I think last time I checked, already 1/3 of all taxpayer money is literally being used to pay interest on the bonds, you know, and 1/3 for me is already quite a high number. If this goes, I don't know, to one, I don't know, half of it or even more, at some point there's going to be a disbalance there, and in a way, the only alternative to that is just printing more money, which is kind of, again, going into this negative feedback loop. So I think the most beautiful thing would actually be if you have the money that is really mathematically controlled. There's a certain amount of inflation that is hard-coded into the system, given certain factors, and that's just how it's going to be, you know? Because I think inflation is not a bad thing per se. It's a bad thing if it's like 100% a year or 200% a year. If it's 2 or 3% a year, that might be fine, you know, because it actually motivates the people to spend the money. So yeah, I really hope that the crypto space can bring this innovation.
Yeah, it just gives you diversity, and you know, you can just always invest your money in Bitcoin rather than US dollar.
Yeah.
But still, US dollar is, you know, is the basis asset for the whole crypto thing.
Yeah.
If there was no US dollar, nobody, I mean, there are some stable coins for other currencies, but you know, the most important ones, USDT and USDCs, that's how money flow into crypto.
What would happen if the US dollar completely goes down, like completely? I don't know. We talk like 99% it's losing its value. What would happen to the crypto space?
Well,
Hope you're not so nice.
yeah,
right?
maybe you don't need to care about crypto space anymore. Yeah, but there are things that happened before. Like there was like a DPEG for some major stable coins. For example, USDC happened a couple of years ago when the Silicon Valley Bank, there was like a problem with the withdrawals from the bank. And since a lot of assets of the USDC company circle, they held the money in this bank, people started stopping trusting to this coin, and all those exchanges where they had you know, USDC pairs, all the prices just went up. You know, Bitcoin wasn't it wouldn't cost the same amount of USD as an other exchange. Let's say another exchange with like 100,000, on those exchange where they trade USDC, it would be like 120 or something. So people just sell all the USDCs into this and try to buy some Ethereum or Bitcoin. I think at some point, I mean, if something this happens, the effect would be like this. So people start buying some, you know, crypto tokens, but to the point, because if it crashes completely, then I don't know, you better buy a gun than Bitcoin.
At some point, I guess you're right.
Yeah.
But I guess it's never a bad idea to buy scarce resources in a world where the US dollar and so on can just be printed arbitrarily. I think this bet so far has been not so bad.
Yeah, it's good that you have a like option to invest in something else rather than just, you know, having faith in the US government.
Only have faith in yourself.
Yeah.
If there's one thing you'd like the audience to take away today from the whole conversation, what would it be?
I think it's very exciting time these days when the whole idea of money is reforming. The new concepts of money arise, and this is getting, 10 years ago or even 5 years ago, it still looked like a joke. It was like a small group of people who would look into this, and they're like a small community. But now all the big banks are involved one way or another in this new world of money, and it's just interesting to see those things evolve. And being a trader or high frequency trader is one of the cool ways to be part of it, especially if you're like a software engineer. It's such an enjoyable thing to do. Actually, that's how I got in this in the first place. I used to participate in those coding competitions a lot, and it's very similar to the coding competitions. Or people would do marathons or hackathons when you have to code for like 24/7. And it's very similar because there are several teams that they compete with each other. They don't see each other. They just only communicate through this order books, through the market APIs. But it's very interesting. It's like a race that never ends, and it's really fun to be a racer in this game.
Great. So I hope you can sprint far enough on this journey. It's been wonderful having this conversation with you.
Thank you.
Thank you so much.
Thank you for hosting me.
Thank you.